Well, good morning, ladies and gentlemen. You've had two regulators, you've had two venues. That's the two sides in this great battle. And it is a battle. A lot has still to be decided. But also, the regulators battle with each other across Europe, and the different types of venue battle with each other across Europe. And not only is there Europe, we have to remember there's also the United States, and they're doing the same thing. Following on from Dodd-Frank. And they have a new category of venue, the Swaps Execution Facility, the SEF, which we have to hope will parallel what we're doing here on the OTF. Otherwise, we're going to have problems with firms which are doing business globally. Now, I'm not a regulator, I'm not a venue. I'm an academic, but I used to be in the bond trading industry. And when I left that industry, at one point I was on a panel, an FSA panel, which was looking at just the same kind of issues we have today. How do you trade securities which are not frequently traded? And that was the Bond Market Transparency Review, which FSA had some years ago. I was also on the market advisory point of the very first MTF in Europe, and that's TradePoint. And TradePoint never got off the ground because the regulators weren't interested, and the rules didn't help it. In fact, it made it impossible to exist and to be profitable. And so we're very fortunate that we have had regulators who now do want to improve competitive conditions in markets. Just a brief word about the ICMA Centre. It's a school devoted purely to financial markets, and one of the key things we have focused on, at least originally, less so now, is the trading side. We do teach people how to trade. Now, MiFID II, I would say, conflates two different objectives. One is to do with efficiency, integration, competition, and the other is to do with the G20 requirement on the parts of the market which they believe caused problems due to lack of transparency, and that's principally OTC derivative trading. And it's very clear we do have to do something if we're going to reduce systemic risk and avoid future crises. And while there are many areas that have to be covered in that respect, what we're looking at today is one of those. But we come back to this question, which is essentially, are all markets the same? Are equity markets just the same as bond markets, just the same as derivative markets? And in fact, some people just talk about equity markets as if they are just exactly the same everywhere, and all trades are just the same. But it's just not so. In markets, you have two types of trading. You have trading which is episodic, which means only occasional transactions, and you have markets which have continuous trades, perhaps 1,000 trades, or 1,000 orders coming into a mechanism a second, fewer trades obviously, but certainly continuous transactions. In the case of swaps markets, even the most active swaps contracts may only trade perhaps 20 times a day. It's not a high frequency market. It's a very, very different market. And that's why we do need OTFs. And that's why I do strongly disagree with the speaker from the Luxembourg Stock Exchange. I don't think you can just say we don't need that. What we have is adequate. And some of the facts on this business, while US Treasury bonds are amongst the most highly traded securities anywhere in the world, once they actually go off the run, then volumes drop to less than 10% of what they are when they are on the run bonds. Also, when we look at the OTC trading business, voice trades are much, much larger than electronic trades. I would say they are different. It's rather like the LiquidNet example. LiquidNet trades are massively bigger than other trades in this business. And so what I would argue is that for what I call episodic trades, which can be two things, it's either large trades in things which are being traded all the time, in other words, large institutional pension fund type orders, which are very difficult to match, to find the two sides, it's very difficult, or something which is actually not trading very frequently. These two types of business do require different mechanisms and different rules. And LiquidNet, it's interesting we have a speaker from LiquidNet on the panel, is, I think, a brilliant solution to this problem of how do we do large trades without violently moving the market. And in the case of OTC derivative trades, voice broking seems to me a much better way to bring the parties together in a very difficult market than any other mechanism, particularly the RM or the MTF. And I really don't think we should be trying to force all types of business onto this one type of mechanism, the RM, MTF, the auction market. When we look at G20, it required that derivative trades be reported. That's perfectly sensible. And non-cleared trades be subject to higher capital requirements. That's sensible. But in terms of trading contracts on exchanges or electronic trading platforms, the G20 was open, it says, where appropriate. Voice trading, I hope, will continue, because without it, I think it's very hard to bring two interests together, particularly when, in order to do that, the dealer is going to have to offset a lot of the risk in other markets in order to be able to do the trades. One of the big problems we have, I think, in our business is that we have become, when I say we, I mean the whole industry and the regulators, very focused on trading and making trading easy and cheap. We haven't been focused on the real side of the economy, which is the governments and the big corporations, the ones who need to do the OTC trading, and we haven't been focused on the real money funds, the big pension funds, who need to do large trades. We have been concerned much more with the trading activities rather than the real end users. And as I said earlier, the two sets of rules may differ. We have to hope they don't differ too much. There's also the question of transparency. And in fact, broker markets are transparent just like any other markets. Prices and depth of trading interest have to be made public. Voice broking helps the formation of tight prices. Without it, you're very liable to not have prices, or if you're forced to provide continuous prices, they will be so wide that actually you won't get any trading done. There comes a point where trying to force a requirement to quote prices all the time to pre-trade prices available will just destroy the market. Now, transparency is designed to help systemic risk analysis. That's a clearly very important part of it. It's also designed to avoid misleading people who are active in the markets. And yes, post-trade transparency is essential, but I still think we need to consider more carefully time to publication of trade. In other words, how long can we delay? As somebody who was previously in the market-making business, I'm only too well aware that if you have to disclose immediately what's happened, you are going to damage the trade and your own profitability, and ultimately either spread widen greatly or you just cease the price discovery and trading process. So my conclusions, first of all, We've a long way to go. I think it's 2014. A lot can happen over the next year or so. The rules that are brought in, I say, should not be too prescriptive, not too restrictive, not trying to say everything should fit in the one box. It's important that regulators don't disrupt what markets have been doing, because there are usually good reasons why they've been doing what they've been doing. Auction markets are great, and it was great particularly in the States, where NASDAQ was a very inefficient dealer market, and once auction markets were brought in, we had much finer prices, much better quality of market. But not everything can go on an auction type market. The new body, ESMA, is likely to, I think, to suffer from regulatory overload, just like Dodd-Frank has created a regulatory overload. And so some things are liable to be swept under the carpet. The smaller venues, I would take Liquidnet as an example. It's a very important venue, very important type of venue, but the regulators probably won't spend as much attention on the issues that raises as they do on the continuous high-frequency trading issues, which are the focus of everyone's attention. So there is always the risk of unexpected consequences, as with MiFID, which is why I say the new rule should not be too prescriptive, and regulators should take care not to disrupt existing types of market structure which do work.
Thank you. Can